Hello, chart watchers, and welcome to this Market Watchers Live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Let's take a look at the action so far today. You can see the Dow Jones Industrial Average currently down 77 points, the S&P 500 down almost 10, the NASDAQ doing better on a relative basis, but still down 12.5 points, and the Russell 2000 clearly the big winner here. So far today, up 7 points. 10-year Treasury yield up earlier today, but it is off of the highs, up just a fraction, 2.97%. Volatility index continuing to hover down around the 15 level. Energy, best performing sector today, up about 0.3%. Part of the reason renewable energy is bouncing, you can see First Solar down near earlier price support from about a month ago, making a little bit of a bounce. The technology group also still in positive territory. So kind of bucking that trend of selling going on earlier today. I would have to say probably the big reason, Apple came out with some great earnings. We did get a big gap up today, up nearly $7 on Apple today. That is certainly helping the cause for technology stocks. The consumer staples area is the weakest, and the reason, brewers. The brewers index down considerably. Molson Coors came out with very disappointing earnings. Gap down, and that is leading the whole industry group and sector to the downside. And with that, let me bring in my co-host, Aaron. How are you doing this Wednesday, Aaron?
I'm doing great. It was an interesting morning. I went outside and there was all this water out there. I mean, it had rained. It was really shocking to go out and not be able to sit on my patio because it was all wet. I'm not used to the rain.
Yeah, and for those of you who are not familiar, Aaron is in Southern California, so it's not supposed to rain in Southern California, but apparently it did last night.
Exactly. It was shocking.
And I
I
know you're not talking a whole lot of hockey, but I feel like I want to talk some hockey today.
Yes. I was just gonna say I actually checked in last night to watch that Caps Penguins game, and oh my goodness, congratulations to the Capitals for coming back and winning that one. That was a great game.
Yeah, and Ovechkin, who he's had a great career. If there's one knock on him, is that he hasn't really stepped up in the playoffs. Caps haven't had a whole lot of playoff success, but a very exciting game last night. He scored with a minute to go in the game to win 4-3, so it was a great game. But been a great series so far, and Pittsburgh will not go down easy, so the Caps are going to have to play their best for sure.
Mm-hmm.
But we'll leave hockey for another day. We got a special guest in here today, and we got Tom McClelland. He was in a few months ago, made some interesting predictions. He's already promised us he's going to follow up on those predictions. Pretty amazing stuff. But welcome to the show. Welcome back to the show, Tom.
Thank you very much, and I'm coming to you live from the Pacific Northwest, as we like to call it, Tacoma, Washington. I tell people that the rainy season here usually begins around October 1st, and it usually ends around September 30th. So if you're planning a trip up here, you kind of want to work around that.
That's pretty good. Now, is it similar to Seattle? Because I've been out to Seattle in the summertime, and Seattle doesn't get much rain in the summer. July, August seem to be very, very dry months. Is it the same in Tacoma?
I know, and the word about the nice summers here is starting to get out, so we really want to quash that so that we don't get overwhelmed by too many people coming in the summer. So we prefer everybody to think it rains all the time.
Yeah, 365 days a year, except in leap years. Anyhow, we're going to get back to you here in about 15 minutes or so, Tom, so stick around. I know everybody's anxious to hear what you have to say about the markets. And with that, Aaron, why don't you go into the announcements for this week, and we'll get through the agenda and get going.
Yes. So for the rest of the week, tomorrow we have Mr. Wyckoff, as I like to call him, Bruce Fraser, will be in to talk Wyckoff with everybody. And on Friday, we have everything stock charts. And I heard rumor that Chip Anderson, president of stock charts, will be doing that segment for us on Friday. So you definitely want to tune in for that. But today, we are going to go ahead and after our technical headlines, we're going to talk to Tom McClellan. He's got a great presentation. Can't wait. And then on next, we will do the 10 and 10 to 1. And our first symbol is going to be BR, Broadridge Financial Solutions. So if you want to go take a peek at that chart before the 10 and 10, go right ahead. And then we are going to finish off with a scooter report, let you know what scooter movers are out there and how you can use the scooter to find stock picks. So we will do that at the end of the show. But with that, I'm going to turn it over to you, Tom B., since we have another Tom in here today, for those technical headlines and news.
Sounds good. You can see the 10-year Treasury yield. We did get up over 3% last week, pulled back to the area of the breakout right around 294, 295, starting to bounce back off of it. Interesting part is that at 2 o'clock today, we're going to get the latest announcement from the FOMC. And so we'll find out whether they're going to change any of their thoughts about interest rates coming down the road. And of course, whether or not they're actually going to change the rates this afternoon. But at this point, the 10-year Treasury yield is certainly in an uptrend and a very key overhead resistance area on the yield at about 305, dating back to 2014. Since then, we've had a double bottom, and so I think getting back through that level would be very important technically, meaning that Treasuries would be out of favor, and as a result, yields moving higher. So that's going to be something to watch. Earlier this morning, we had the April Adp Employment Report out. Of course, this is a little bit of a precursor to Friday's non-farm payrolls, and the ADP employment report came in at 204,000. Market was only expecting 190,000. I have noticed, though, several times over the last year or so where these two flip-flop. One beats estimates and the other one comes short, falls a little bit short. So we'll see whether or not the non-farm payrolls follow suit and beats expectations. But as you can see today, not a whole lot of movement in the Treasury yield, despite that beat on the employment report. I do want to mention, though, the dollar continues its move to the upside. You can see another move, another breakout. This is, I don't know, over the last 10, 12 days, it looks like we've been up all but 2 days. We had a couple of minor small losses in the dollar. Otherwise, it's been a straight up move. It is starting to play catch up with the difference in the Treasury yields between the U.S. and Germany, which has been moving higher for quite some time. We've talked about that on many occasions here on the show, expecting the dollar to break out. I know Erin, when she's done her analysis of the dollar, also has been looking for strength, and it looks like we are finally getting that to the upside. Part of what is happening, though, as a result of that, continues to happen today. We saw earlier when I went through the update, the Russell 2000 is outperforming today, and that has been the case really over the past couple of months. And if I put this on a line chart, you can kind of get rid of all that noise, but you can see we bottomed, had a double bottom in here, Russell 2000 versus the S&P 500, and talked about this maybe just being a temporary move to the downside, that a rising dollar historically favors small caps over the benchmark S&P 500, and it should. Anytime you've got a rising dollar like we're seeing right now, that cuts into earnings of multinational companies that do part of their business, or in some cases, the majority of their business, overseas. So as you translate those gains back into the dollar in the U.S., it does cut into earnings. So that's something to keep in mind here over the next couple of months as the dollar continues to rise, and I think it's going to continue to rise. But that is helping the Russell 2000, because as money rotates in many different ways in the market, a rising dollar a lot of times will move money from the S&P 500 into the smaller cap Russell 2000, because those companies are not impacted by the movements in the dollar. They do all or close to all of their business right here in the U.S. So we've got that. A couple of other things. We mentioned Apple's earnings. Let's pull up the chart. Apple still in the trading range as far as I'm concerned, but we did get a nice response. You could see the volume picking up the last couple of days. So there was the anticipation of a strong report. We got that strong report. However, we haven't made a breakout. So over the last several months, you can see Apple really trading just about where it was back in November. So we're talking, 6 months ago? Not a whole lot of movement. So Apple, I think part of what's going on with the market right now is it's still looking for leadership. And even though we've seen great reports out of Amazon, Microsoft, Intel, Apple, these companies are really struggling to break out and maintain that thrust to the upside. Now, when Apple reports, there are a lot of other companies that are related to Apple. Apple's such a big company. A lot of their manufacturers and vendors and so forth do get impacted by their reports. So I wanted to just bring up a few that typically get mentioned when we talk about Apple. One is Cirrus Logic, which has been downtrending for quite some time. Finally did get a breakout above its 20-day moving average today. So we'll see whether or not Cirrus can continue that move to the upside. Then we got SWKS, which is Skyworks Solutions. Also has been downtrending for a while, getting a little bit of a break. But you can see overhead resistance Price resistance is coming in at 94, as is that declining 20-day moving average, which Skyworks has struggled to get through. So black candle right at that 20-day moving average, kind of ominous in my opinion. Corvo, talked about this one the other day. It's in the semi space, had a really good day. I think it was yesterday where it was the best performer in the S&P 500. But as it moves higher, talked about 74 up to about 75 or 76 becoming an issue. Overhead resistance, price resistance, gap resistance, and the 50-day moving average. We moved up earlier, but you can see it has retreated off of that earlier high. Corvo may have problems continuing its move to the upside. Finisar, FNSR, also has been in a downtrend. I'm kind of getting this feeling that from all these other companies that work with Apple, these stocks do not look particularly strong. And so despite Apple's move up this morning, these companies really have not been participating. And you can see Finisar trying to get up past prior resistance, which is at about 1640 or so. And then we had a prior low from early February at about 1675. Today's high, 1643. This is a pretty key area. And to be honest, Finisar is going to need some more volume probably to get through this overhead resistance. And then finally, Broadcom, AVGO, another one that gets mentioned a lot of times. And again, you can see battling major price support down just beneath that 225 level. So those are some of the companies I think you have to be at least aware of when we start talking about Apple and Apple's earnings and what they're looking for down the road. These are companies that tend to go along for the ride. And as we just took a look at 5 of them, they really don't look very good on their charts. Let's talk about the renewable energy space. A couple of days ago, talked about how we don't like to see these long tails on false breakouts, and that can be a short-term warning sign for traders. Take a look at what renewable energy has done the past 2 days after that false breakout last Friday. Big move to the downside. We got almost down to the price support area, and now we're starting to bounce. One of the reasons, I mean, if you look at First Solar, and I think technically this is sometimes considered a semiconductor, I look at it as a renewable energy stock. Here, I mean, the chart looks almost exactly like the renewable energy. False breakout, 2 days of pretty intense selling, talking about a stock that was almost $82 on Friday at the high. Here it is Wednesday, and it hit a low today of 67.28. It's a pretty big haircut just over the past 2 days, and you notice the volume has not been light. So you've got pretty good support around 67 or so, and we are bouncing off of that area. So far, so good holding support. I did want to mention one other stock that's in the renewable energy space that I think looks pretty good. Gapped up on very strong volume just a couple of weeks ago, made a huge move up, did make a breakout. But again, look at that tail on the false breakout and the move back down. Came all the way back down. Looks to me like it's testing pretty key area of gap support and price support between 8.25 and 850. Move back over the 20-day moving average is what you want to see here. But off of that gap up and move up to $10, we've now pulled back about 15% on the stock just in the last 7 or 8 trading days. And this one could be setting up at gap support. Might want to keep an eye on that. Let's talk about some of these earnings because they were big. Apple, I mentioned. Apple came in better than expected on the top line, $61.14 billion, only expecting $61.10 billion. Bottom line, $273 versus $269. I've already pulled up the chart, so I'll leave it at that. A couple of other stocks that came out with earnings in the biotech space. Gilead missed on the top line, missed on the bottom line, has been trending lower for the past few months. And you can see very heavy volume on this gap down. I'm going to pull up a weekly chart. Let's take a longer term look at Gilead. Longer term, we've been moving lower. And even though we did get a push to the upside later in 2017 and in January of 2018, the overall trend here has been down. And if you remember, biotechs were actually performing pretty well for quite some time. So I think if we look at this and go into that relative chart, and I'm going to step it up to a weekly chart. Let's go back those 3 years and take a look at what's been going on with Gilead. Hasn't been good. But there's your price action on Gilead. Here's the biotechs. This is what I was referring to. We actually went up on the biotechs and took out the high from a few years ago. But if you look at Gilead versus where it was much lower. So what you've got is a stock that has been underperforming its peers for quite some time, underperforming the S&P 500. And the biotechs themselves have been underperforming the S&P 500. And so what happens? Well, we talk about it all the time. Price action precedes fundamentals. That's what technical analysis is all about. And Gilead has been warning us for quite some time, especially over the past few months on this move to the downside, following the biotech's move to the downside and turning back down on in terms of relative strength, that you probably shouldn't have expected too much out of their earnings report. $5.09 billion in revenue. Market was looking for $5.42 billion. So a pretty big miss on the top line. Bottom line, $1.48 versus $1.66. So we're talking about another pretty big miss there, about 10% lower than expected. And Gilead, as a result, you can see not a great performer. Market was not expecting a good report, and they didn't get one. A couple of others. Let's take a look at some that came out this morning. Let's see. Estee Lauder, EL. Gap down there. This is interesting. I didn't see what their guidance, how their guidance was, but listen to these numbers. $3.37 billion in revenues. Market only looking for $3.23 billion. Nice beat there. And then bottom line, $1.17 versus $1.07. And the reward, a big down move, down over 6%. A lot of it built in. We've seen this continually really in this earnings season where we've had solid reports, many times gap ups and failure. This time a gap down. But again, maybe there was a warning out there that I didn't see. But Estee Lauder having a really tough time today, down again, better than 6%. Just a couple more. Snap. Snap snapped last night. You can see after the big gap up, and this is why some, I've been asked when a company comes out with good earnings, why don't you want to just stick with it? Well, take a look at what Snap did 3 months ago, their last quarterly report. Traded over 200 million shares, gapped up, moved higher. I've traded this one a few times over the last few months, thinking that key support levels were going to hold. They never did, and this is why you don't hold a stock into earnings. Snap down to 1140 today, down 19% off of all this selling, probably losing a lot of confidence among the analysts on Wall Street with the numbers that they came out with. They missed on their top line. I think they matched on their bottom line, but they were short on some of their key metrics, and so the stock really being slammed today. CVS reported. Let's pull up CVS chart. They missed on their top line, just marginally, not by a lot. They beat on the bottom line, $1.48 versus $1.39, and their reward is a drop of only 3% today. Garmin, smaller company, but one that I like to follow. They did beat top line and bottom line, and here's one that's actually getting rewarded. Had been trending lower. It gapped up. Now, what I would be really careful about, I'm going to annotate this one. You've got this reaction high close right here off of this gap down on massive volume. We never had a candle body that has finished above, opened or closed above 61.25 roughly. Currently, we're breaking out above it, but this would be one of those cases where if we fail to hold it into the close, we move back down and close below 61.25. I would be really careful here with Garmin. So you want to see that breakout continue. PPO starting to rise. Just make sure that we don't have a failure by the end of the day if you are looking at Garmin or if you own it. Finally, let's just talk about one or two upgrades, downgrades. I know there was a downgrade on Alta, and this stock had begun to look pretty good on its chart. So I wanted to see what the reaction has been on Alta today. Really not bad. Beautiful move to the upside. Aaron and I talk about this all the time. Sometimes you get a downgrade and it's an opportunity to go long. We did have that long tail to the upside, kind of signaling maybe things were going to be a little weak in the short term. We had a little weakness yesterday, got the downgrade today. We were much lower, but now we're leaving this long tail to the downside. I think Alta looks good. And if you take a look at their long-term monthly chart, this has been a really good performer for a long time. But on a monthly basis, we had higher prices, a lower PPO, so we had a negative divergence on a very long chart. Notice we went all the way back down, all that weakness that we saw in the second half of 2017 and the struggles we had to start 2018. Essentially what it did is it reset its PPO on the monthly chart. So interesting stuff there. And I don't want to waste any more time. I want to get on to our guest, Tom McClellan. Tom was here 3 months ago, and I got to say, made some very interesting predictions, couple of really good calls. And I know, Tom, you were looking at the corporate high yield bonds and the advanced decline line there, seeing a negative divergence. You thought that was a little bit of a warning. And then you also talked about euro dollar futures. and how you've developed this almost, I don't want to put words in your mouth, but it's almost like you can see the future of what may happen with the stock market. And so far, things are kind of unfolded the way you talked about 3 months ago when you were on with us. And welcome back, by the way.
Well, glad to be back, and we're going to review that again. I'm going to try to figure out the switchology. Shall I share my screen now?
Yes, sure. Go right ahead.
Okay, stand by while I figure out how to get the right screen. Okay, there we are. So the theme for today is it's a nearly perfect bearish storm. You're never going to get absolute perfection, but there's a lot of bearish signs and a few conflicting signs, all lining up to tell us what's going on. Okay, there we go. So I'll get to that Eurodollar commitment of traders indicator that you mentioned in a moment, but wanted to go through a few of the signs. The first one up is another way of getting a future indication. It's by looking at what crude oil says. So let's start with that. Here is a chart of all the history of crude oil that I could get my hands on going back to 1890, when crude oil was hardly used at all. And something I had noticed years ago was that the price pattern of crude oil over the long run really looks a lot like the price pattern of the stock market, in this case modeled by the Dow Jones Industrial Average. So I put them both on a chart together. It wasn't quite perfect until I started playing around with alignment a little bit. And when I pushed the crude oil data forward on the chart by 10 years, bing, the magic appeared, and it's been working ever since the Dow Jones Industrial Average came into existence in the 1890s. So what the short answer is, whatever crude oil is doing now, that's what the Dow is going to do 10 years from now, or roughly 10 years. It doesn't always work out exactly to 10 years. So for example, the peak in 1920 in oil prices was matched almost 10 years later by the peak in September of 29 for the stock market. So not exactly 10 years. Sometimes it's a little bit more, sometimes it's a little bit less. So don't take it exactly literally as 10.00 years. It's roughly a decade. And that's an important point to understand when we zoom in a little closer on just the most recent time period. This is since 1998 for the Dow. You'll notice that in 1990, crude oil prices spiked up, and we got a top almost exactly 10 years later in the Dow, but not exactly. And it didn't match that Iraq war spike. Right now, we're seeing a top that's the echo of the crude oil peak in 2008, but it's not coming exactly 10 years afterwards. It's a little bit off, but it's off by a tolerable amount. There's a little bit of lead and lag in the amount of lag time. That sometimes it's a little more than 10 years, sometimes it's a little bit less. But the mission right now is for the stock market to execute a decline that is the echo of the big crude oil price decline that we saw in 2008. And I think that we have already started that.
Hey, Tom.
Yes, go ahead.
Okay, when I see a chart like this, first of all, it's extremely interesting. I mean, it certainly looks a lot like what happened, previously, when you take that 10 years into consideration. But, when I look at a chart like this, I try to figure out the theory or why it would work this way. Do you have any idea why?
I do too. I would love to know the why. But why can get you in trouble if you keep chasing after it, and if it keeps you from seeing the is. Going back a chart, this is something that has been working for the entire history of the Dow Jones Industrial Average. And so at some point you say, okay, I've got enough data to establish that it is working that way. It doesn't work perfectly, but it's been working for decades and decades. And at some point that's enough to get past the why. I would rather have a why. I studied engineering. I'd like to know everything about how anything works. I like to take stuff apart and know the inner workings of it, but we don't always get to know the why. So it's a lousy answer to your question, but that's the answer I have.
Well, I'm a CPA, so I also like to find the why sometimes. I try to avoid looking for the whys and technical analysis and how the prices and so forth stack up. But that's just amazing to me that you have a 10-year difference like that, and it works out the way it has.
And it's not perfectly 10 years, and the replication of the pattern in crude oil is not perfect. And so don't expect that you're going to get perfection. You're just going to get something that's really, really good. And so the bad news for stock market bulls is we've got this 6 to 7 month decline to do, and we've probably already started it, I believe. But then the good news is once we get to the bottom, whenever it is, that's the echo of that January 2009 crude oil bottom, then we have a reestablishing bull market for years ahead. And so that's good news.
Mm-hmm.
Moving on, here is my magic Eurodollar commitment of traders indicator. And just to review what we're talking about, this is not the euro currency versus the dollar currency. The term Eurodollar goes back many, many years, and it refers to dollar-denominated time deposits in European banks. So this is not a currency issue. This is an interest rate futures product. And what we're looking at from the Commitment of Traders Report, or the COT report, is we're looking at the net position of the commercial traders. Those are the big traders, the big money guys, usually the smart money guys. And you can see that right now they are net long as a group. Their position and the way that they change their position tends to give about a 1 year leading indication for what the stock market is going to do. And it's been working since about 1997, which is when this Eurodollar futures contract first became the big instrument that banks would use to hedge their loan risk and their deposit risk. So I don't have a good explanation for the why on this one, other than that somehow the bankers and the way that they lay off their deposit and loan risk seems to give us an idea about what the future fund flows into and out of the stock market are going to look like. And so what you're seeing in this chart, the red line, the Eurodollar commitment of traders leading indication, it's shifted forward by a year. So its movements now are telling us what the stock market will be doing a year from now. So we can look at what it was doing a year ago and tell us what the stock market's going to do. And you can see that there is a big decline coming. If I can get my mouse working right here, this early 2018 top and big decline is what we're going through right now. But the good news for the bulls is that after a bottom that's due around August, we should have a nice big rebound. Now, it did not work worth a darn in 2013. And that was because the Fed had its thumb on the scale, pumping in $85 billion a month worth of quantitative easing, or QE3, that really ruined the negative message of liquidity from what these bankers were saying. Eventually, they got back on track and started working again. And as QE3 dwindled down to nothing, the negative message started working again. Right now, we don't have QE3. We have quantitative tightening. The Fed is taking out $30 billion a month out of their holdings and forcing the market to eat that. And that's reducing liquidity just in the same way that QE3 and 2 and 1 increased liquidity. And so we have the combination message of what the Eurodollar commitment of traders message is saying. Plus, we also have the Fed turbocharging that by yanking money out. Zooming in a little bit closer, we can see the more detail. I had been looking for this March top based on what the Eurodollar commitment of traders indicator said, and we got a March top. The NASDAQ itself topped in March, but the Dow and the S&P did this weird rogue wave kind of thing where it zoomed up extra high and then it corrected that by zooming down extra low and then got back on the normal track. We've been wading through this little right shoulder structure, and now we're getting into the meat of the decline just ahead.
Can I give a follow-up question on there as well? Because I know when you were on the show the last time, I think you were saying that the movement in terms of percentages for the Eurodollar, that we shouldn't really look at that compared to the S&P or the Dow. And so I just wanted to clarify, or maybe you could clarify that that additional move to the downside that you show there on the Eurodollar for the next several months. Are you suggesting that the Dow or the S&P is going to follow that move to the downside, but not the same percentage? Or what are you looking for?
Exactly. This is a roadmap, but you should not take it literally in terms of forecasting some magnitude of a move. It's a question I get all the time. How far am I expecting prices to move? And what I tell people is I try to get the direction right and let the magnitude take care of itself. The problem with forecasting magnitudes is that we don't know how the market's going to get bent by events that have not happened yet. This is not as reliable as I wish it was for magnitudes, but it's not too bad. If we can, I'll look back one chart here. If you look back at the magnitude of the decline that we had in 2007 to 2009, that was a pretty big price decline, and that was similar to what the Eurodollar commitment of traders indicator was saying. It's saying a big, ugly decline. It said a less ugly decline in 2015, and we got a less ugly decline, but it was still a bear market period. So we're seeing decline similar in magnitude to 2015 and to 2016. So we're not talking about having another 2008 bear market, but at the same time, the Fed is going to magnify it with their quantitative tightening. So don't necessarily think that we are going to get only a little decline. I'm looking for it to feel ugly until we get to around late August, around August 27th or roughly, and then it goes screaming back up again in parts that are off the chart right now. I cut off the right part of that chart because I just wanted to focus in on what's happening right now, and this is the big ugly that we have just ahead of us for the next several weeks.
So do you think this is a bear market as opposed to a sizable correction, or you don't care?
I do think it's a bear market because my definition differs from the one you hear on CNBC all the time. Forget about the 10% and 20% thresholds. That's just ridiculous. A bear market is when the majority of stocks are going down for a long period of time. And the whole 10% and 20% originated in the technical analysis shop of Smith Barney. I learned this from Louise Yamada. She worked with Alan Shaw there, and he would throw around terms like a correction or a bear market, and the brokers at Smith Barney would always get confused. Like, what do you mean by this versus that? And so he gave them a little rule to go by. He says, if I say expect a correction, then think of something that's around 10%. Or if I say bear market is coming, then think of a decline that's going to go around 20%. CNBC turns it around and says, well, such and such a stock is in official bear market territory because it's down 20%, which is ridiculous. You can't have a single stock be in its own bear market all by itself. That's like a single city block having its own hurricane. It just doesn't make sense that way. Bear market is something where liquidity is tight and it affects most stocks and lasts for a while. And that's what I'm expecting between now and that August bottom.
Are you shorting?
Yes, I'm short right now.
Okay. Well, is there something, I guess, maybe to clarify for all of our listeners out there, is there something that would trigger you to cover your short? Is there a point on the S&P 500 that you're looking to maybe as a potential top where if we break through it, you would cover?
Well, what this message of this chart says right now is that we should be going down in a big fat hurry. If something goes wrong, we start making higher highs, that would be breaking this pattern, and something drastically different is going on than what I'm expecting. And so I would look at that as my sign to get out of this and rethink everything that I'm looking at. But this is not the only indication that I'm going off of. I'm seeing lots of other things, the crude oil message, the quantitative tightening, and we're in the second year of a presidential term. Mm-hmm. The first 2 years of a new president's term are generally flat. The first year is more up than the second year. I start this with my presidential cycle based on the election time, not January 1st. So generally speaking, on around April 19th of the second year of a president's term in office, you start a decline that lasts until just before the midterm election. We're now entering that period. And so we've got the combination of crude oil's message, the euro dollar commitment of traders message, and then normal second year seasonality. We're in the worst 6 months, and we're also in the worst 6 months of the worst year. And the market seems to be getting itself into step with the pattern of the presidential cycle pattern, which says that we're going to be in a bear market period until just before the midterm election. And then we get a nice screaming uptrend as we enter the third year, which is nearly always an up year. You have to look at 1931 and 1939 to find instances when the third year was not an up year. 1939 was when Hitler was marching through Poland. 1931 was in the middle of the Great Depression when the Fed was screwing up and the executive branch and Congress were screwing up and Smoot-Hawley. So if you have conditions like that weighing on the market, then you can get a down year in the third year. But generally speaking, you have an up year. So that's something to look forward to when we get to after the midterm elections. We have a nice big return to an uptrend. But for the next 4 or 5, 6 months, we have a rough period to get through.
Does this second and third year, does it also include incumbents, where we've had a second term, or is this just the first term of presidential cycle?
For this version of the presidential cycle pattern, it's including first and second term presidents. They're all rolled in together. There is a difference, which I didn't plan to discuss today, between first term presidents and second term presidents. And the difference stems from the normal behavior when you get a new president coming into office. What they all have done in my lifetime, they discover that, oh my gosh, conditions are even worse than I told you during the campaign, and that the only solution is whatever package of tax cuts or tax hikes or legislative changes or whatever. And people get bummed out hearing that things are worse than they thought. And that's why the first 2 years of a new presidential term are really not good, because you're getting all these negative messages all the time. We haven't had that really this time. Mr. Trump is a different sort of president, as many people have noted. And so the market's been able to trend higher, partly because all that quantitative easing money is still sloshing around. Now it's coming back out. But the worry about what the midterm election is going to mean for the future and whether the houses of Congress will change hands, that starts to weigh on everybody's minds. And so that's why, generally speaking, from about April to September, October, you have a lot more worry that people are feeling. And that's why the stock market tends to trend lower. But then once that worry is resolved, and it doesn't really matter how it's resolved, just getting it resolved in some way gets everybody feeling better again. And then the market starts to trend higher again in the third year. So we have that to look forward to, but not today.
Well, I do have a question coming out of the chat room. And, we're talking about moving down into August. And their question really is, do you have any technical levels to the downside you're going to be watching as far as support?
No, it's strictly based on time. It can go a lot farther than anybody thinks because of the Fed putting their thumb on the scale the other side. Now, we're taking $30 billion a month out of the banking system right now in this quarter. When we get to the Q3 starting in July, the Fed says it plans to up that to $40 billion a month that they're going to be withdrawing out of the banking system. And that's going to have a tremendously negative effect on liquidity. The last time the Fed tried to reduce the size of its balance sheet was 2008, which was just a horrible time to do it. We're in a much better time now than were in 2008, but the effect of taking that much money out of the banking system reduces liquidity in such a way that it's a big negative. And so that really makes it much harder to forecast how much of a decline we're going to see.
All right. So there's not actually any kind of downside target at this point you're looking at as a possible stopping point, but more.
Well, my downside target is August. Let's just say it that way.
There you go. And one of the other questions is, given we are going, heading lower in your estimation, are you shorting individual stocks or indexes or, ETFs, or do you just have a mix?
Shorting using mutual funds and ETFs, shorting the overall market. Let's just say it that way.
Okay. Yeah, I think that's pretty good. Let's see if we had any other. Oh, your current outlook for oil. I know that's sort of on a different subject, but people were interested in that.
Well, the commercial traders, the smart money, they are net short crude oil futures to the largest degree in history. So I kind of believe them. I believe they're going to be right. They think this is a really good price to lock in for all their future production. So they're doing it. So I don't think it has the ability to go much higher.
Okay.
If we can move back on to some other things to talk about. One of the fun things about why we're seeing volatility creeping up now is because there's another leading indication relationship shown in this next chart. What I'm showing is the 3-month T-bill yield, and I'm pushing it forward 2 years. And so when you get rising short-term interest rates, then you get rising volatility about 2 years later. And that's the message. We're finally getting to the 2-year echo point of when the Fed started to raise short-term interest rates. And so 2 years later, bing, we get a big sell-off in late January to early February and higher volatility index readings than what we're used to seeing. So this is all happening as it's scheduled to happen. And the rising rates that have been continuing upward are going to continue to raise average levels of the VIX, just like they did in 2007 and 8, and just like they did back in the early part of this century. So this has all been forecasted. It's all been put into the toothpaste tube, and it's starting to be squeezed out right now. Let's see. Now, here's the one fly in the ointment for my bearish outlook. This is the New York Stock Exchange advanced decline line, and it made a slightly higher high just recently. So it's not showing us a big classic bearish divergence like you'd expect to see ahead of a giant ugly bear market. That's one fly in the ointment. That's one positive factor. I think that all of the rest of the negative factors are going to outweigh it, but this is one positive factor that doesn't fit with my whole hypothesis. and I think it can get to where it does fit better shortly. However, we are seeing really ugly breath numbers somewhere else. And this is something I showed last time. This is an advanced decline line for corporate high yield bonds or junk bonds. And it is a really great, it's probably a better canary in the coal mine than the New York Stock Exchange advanced decline line. These are the most liquidity sensitive issues. And so when liquidity is really, really strong, they do great. And when liquidity starts to get tight, they will start to die off and decay ahead of everything else. And what you saw is it gave us a huge divergence when we had the final price stop in January, and it is refusing to climb back up on every rally attempt. And now, just as of yesterday, it made another lower low. So it's still saying things are bad and getting worse. And so if you're looking for a message about liquidity, these guys are telling you liquidity is tight, and what little liquidity that there is getting marshaled into just the right sorts of stocks to keep the stock market from crashing right now. Eventually, it's going to come around and bite them as well. Everybody understand that so far? I wish this data was easier to get access to. I have to go here's the URL for the website. FINRA makes it available, and it's a really long URL, I have to go download it by hand, one day at a time. But boy, is it good data to get, and it makes it worth all that trouble and effort.
All right. Yeah, we did have some people asking about where they can find these charts. I'll certainly post what you're presenting today, but as far as
you can approximate it by looking at the junk bond ETFs like HYG or JNK. When they're doing really, really well, that tends to be a good condition for the overall stock market. And they've been showing lots of trouble the last several months as the liquidity is drying up on its own, and as the Fed is helping that process, plus the higher interest rates that the Fed is bringing in are helping that effort. So they're all conspiring together to take liquidity away. And generally speaking, the only two fundamental factors that matter for the overall stock market is, number one, how much money is there? And number two, how much does that money want to be invested? So the Fed is working actively on reducing number one. And now that we're into the summer before a midterm election, the money is going to have even less interest in being invested as everybody starts to worry about what the midterms are going to be.
Indeed.
Now, I promised you one really bizarre chart. And if you like charts, this one's kind of fun. So I noticed this years ago, and I put it together. Here's a chart of the Dow Jones Industrial Average going back to 2008. And if you look at this chart, okay, it's swooping upward and to the right, but you could turn this upside down, and it looks pretty much the same, down to and including individual bits of detail. So what I did is I created a chart that does exactly that. You're looking at the same chart with both plots, just that the red plot is the black one turned upside down and backwards. So what we're doing right now is we've seen a top that is the equivalent of the March 2009 bottom, and we're going downward just like that pattern suggests. Or you could look at it at the other end. You are here now. And so what we have done, this is like what the Beatles used to be accused of doing, a musical technique known as backmasking, where if you play Revolution number 9 backwards, you'd hear the message that John is dead. Well, the market seems to be playing its own song backwards, and so we're matching the pattern of the decline that led from the 2007 top into the 2009 bottom. We're just doing it upside down and backwards. Kind of bizarre, kind of different. I don't know of any other example in history of where this has ever worked. And it hasn't worked perfectly here because you see little inversions along the way, but it's generally matching up the pattern along the way. And it's a kind of fun bit of chart magic. We'll see if it continues working, but if it does, then we've got even more decline yet to do.
I don't even know what to say about that one.
Yeah, I know I was not smoking mushrooms when I thought this up. It's just, I happened to notice that it looked a lot like it, so I did some coding and made it to where I could turn it upside down and look at it, and it's still working.
Wow, I think that's the engineer coming out.
Yep.
Exactly. So we did get one other question. You know, you were talking about shorting going into this phase of the market. But are there any safe haven asset classes or anything that you also would be looking at?
Safe is not a word I ever use because there's no such thing as a safe investment. Even if you took your money and put it all in cash and put it in your mattress, your house could burn down, or inflation could eat away the value of it. So there's no such thing as a safe investment. All you're ever doing is you're trading one thing for another. And some things are better to have it sometimes, and other things you want to have at other times. And so we're looking to harvest the change in value that the market is serving up to us.
Let's see. I'm keeping close tabs on this. Everybody wants those charts, and I do want to let everybody know that I will be posting what was presented today in the Market Watchers Live recap for today, and you'll find that in the Market Watchers Live blog. But I'm looking at the screen right now, and I think you can elaborate more.
Well, this is my thank you for tuning in. Here's my commercial. If people want to find out more about the work we do, we have a website. It's listed right up there, mcoscillator.com. That's just a contraction of the McClellan oscillator, the indicator that my parents developed back in 1969. My dad's still alive. I work with him every day. My mom passed away in 2003, but their work continues on, and you can read about it on our website. You can find out about subscribing to our subscription publications, or you can just sign up if you want to get a taste of it. We have a free weekly chart and focus that comes out by email and get posted on our website. It's people ask me when I'm going to write a book, and I say, well, I've been writing one since 2009. It's just in serial format, one article per week.
Exactly. I feel the same way. Unlike Greg Schnell, I haven't gotten my book written and out there yet. Maybe one day.
Hey, Tom, I got a question for you. I'm gonna take the screen for a minute and just see if you have a comment on this chart, because I show this every once in a while on Market Watchers Live and in my blog. This is the S&P 500 going back the last 15 years here at the top. And then what I do is I look at the various sectors relative to the S&P 500. So I'm just looking for leaders and laggards during different periods. Now, the two red vertical lines that I have here mark the bear market from 2007 to early 2009. And, leading up to that bear market, and what I would expect in a bear market is for those who, maybe are seeing the bear market approaching to reallocate some of their, portfolios, investments, and so forth, and move more defensive in nature. And what we saw back in 2007 was when we topped on the S&P 500, and I'm assuming, we're looking already at a top here in 2018. But at that top, over the next few months, or next year, really, with the exception of industrials, we saw weakness in the aggressive areas of the market. And even leading up to the top, we started seeing the consumer discretionary space really weaken pretty badly. And financials as well. Of course, we had a financial crisis, which was the kind of the centerpiece of that bear market. But when I look at this market, and it's one of the reasons why I'm really having a problem getting, into bear market mode, I'm looking at the technology stocks continuing to trend higher on a relative basis throughout this move to the downside. The consumer discretionary doing the same thing. We are seeing some weakness in industrials, with financials relatively flat. And the defensive groups, you can see consumer staples, which tends to rally very significantly during a bear market, as does utilities. And also, you can see for about a year, the healthcare. Two of those three are still moving down, with utilities the only one kind of gaining ground against the benchmark. Any ideas or thoughts? I mean, maybe this doesn't really pique your interest at all, but for me, one of the problems I have looking at this and thinking bear market is that money continues rotating for the most part into aggressive areas of the market. Do you think everybody's just got blinders on?
Well, I think it's a case of there's a couple of 800-pound gorillas that are making it different this time. Last I checked, in the consumer discretionary, Amazon is the largest component in that, and it's 27% of that index. So it tends to really be the gorilla in the room that gets to sit anywhere it wants. And if you look at technology, Apple is going to be the biggest piece. And I saw an item on Twitter today from Robin Wigglesworth. He's a U.S. markets editor at Financial Times. He had a great note to just tell you how big Apple is. He says Apple's annual dividend of $13.2 billion, that's the biggest in the world. And the dividend that dividend is bigger than the market cap of 141 members of the S&P 500. So Apple is an enormous, it's bigger than several countries. And so what it does tends to move those indices around in ways that may be disguising the message.
Yeah, I've heard, that theory. I guess one question I still have, though, is Amazon and Apple immune from a bear market? I mean, it seems like if business is going to dwindle, if our economy is going to, maybe start to move lower and retract a bit, wouldn't Apple and Amazon be subject to those pullbacks as well?
Yes, they would. I liken it. The subject of liquidity is really a nebulous term, and it's not one that you can just put a units on and measure it. You remember when we studied economics, the professor would talk about utils, which is a silly idea. You can't really measure any units of liquidity. It's like the wind. You can only know what it's doing based on what it does to other things. And the best analogy I have is to a mother pig with a litter of baby piglets. And if the mother pig is a great producer of milk, then all the little piggies are going to survive. But if liquidity dries up in the mother pig, the 2 or 3 biggest of the little piglets are going to muscle their way in and get to where they can drink the best, but the runts are going to go starving. And so if you really want to evaluate how liquidity is doing, you look at the runts. And that's why we look at the junk bonds. You look at the overall advanced decline line. The runts are starting to suffer already. And eventually, if liquidity dries up more, then the big piggies are going to start to suffer also. Apple and Amazon are the big piggies who can get the liquidity away from the mouths of all the other stocks for a while. But eventually, if the liquidity really does dry up, then it'll come around and bite them as well.
Okay, fair enough. What has been an awesome presentation. Just as awesome as the first one, maybe even better. And especially, the thing that's interesting here is you were on back on January 17th when everybody, we were running polls back then. Aaron, you remember this. Is the Dow Jones going to hit 30,000 in 2018? Because everybody was bullish. We're thinking all these bullish thoughts, but you came in and on January 17th near the peak and started talking about these things ahead of time. And we certainly have seen things deteriorate quite a bit over the last 3 months. So it's awesome having you on the show. I think your presentation is very interesting, very compelling, and I think our audience would agree as well.
Well, thanks very much. I do like it better when I get the answers ahead of time and then look at confirming indicators to make sure that the answers I had ahead of time are turning out right. And I tend to trade with greater confidence if I know the plan and if I see that the plan is still working.
Yeah, I'm ready to just fast forward. I want to start trading August. I don't want to trade this anymore. But it was great having you. I really appreciate you stopping by, Tom, and we look forward to having you back soon.
Thanks very much.
Awesome job. Wow, very enlightening. No doubt about it. Wow, I don't even know what to do to follow that up. That was awesome. And some of those charts, and again, I was looking at that oil chart, and I'm like, I'm trying to figure out, and I know it's the CPA in me. I want to try and dig in and find out why that works. And I know with technical analysis, we're not supposed to argue with the price action, but in this case, it's price action from 10 years ago that is leading what's going on in the market right now. And I can't figure that one out. I'll be thinking about that one all night, probably.
Yeah, I agree with him with the why. That's, I guess at this point, the why it happens isn't as important because the pattern is so clearly there. It's very strange.
Yeah, but I mean, there could be a pattern.
Right.
I know over
As
a long period,
major, I know exactly what you're talking about.
Yeah, you can force feed your data, and I'm not saying that's what Tom's doing because he had a number of different arguments calling for the market to go down. I find them very compelling. I thought it was an awesome presentation, but there's one part of me, especially with that oil chart, that is just like, how in the heck does this work? I mean, could I go back and look at weather patterns for Japan back, in 1992 and maybe tie it into what the stock, I mean, you know what I'm saying?
I know.
Again, I'm not lessening Tom's presentation because I thought that was absolutely awesome. But, you do, and as he mentioned, being an engineer and having an engineering background, you want to figure out why something works. But I guess at the end of the day, until it doesn't work anymore, you just go along with it.
Yeah, it's very strange that pattern continues to be on point.
Wow. All right. Well, I know it's time to move on to the 10 and 10. So let's get going here.
Indeed. And here we go. We have 39 requests that I got in before now. I'm waiting for everybody to go ahead and go in there and like the stock symbols you want, because the most popular will be the second one. But let's go ahead. I'm going to show you really quickly the RRG. And we'll take the shorter term view, since we really, these 10 and 10 stocks we're looking at in the very short term. Well, that's pretty ugly. There we go. All right. Really interesting traveling here. Let's see. I'm going to take these down a bit so we can see a little better. But anyway, I think that there's some pretty interesting ones listed here in that blue sector. Look at RDN is on its way up in the proper direction. And as far as our sectors are concerned, lots of cyclicals and technology. That seems to be where most of the interest is. But with that, I'll pass it back to you. And BR is our first symbol.
All right, let's pull up the screen here. I do want to mention yesterday, actually, the first stock that we looked at yesterday was this Federal Signal Corp. And I remember it was down, and we talked about this, and I like to pull these back up when they kind of, do something that we talked about. But here on FSS, it had been in this downtrend, and we were looking for some kind of a reversal here between 21 and 21 and a half. Notice with the market kind of regaining its composure late in the day yesterday, we did get a reversing candle, a hammer right at the support level. Stock's up almost 2%, going up, testing some overhead resistance. So anyhow, pretty interesting stuff. I thought, let's get on with BR. So the first one today is Broadridge Financial Solutions. We've pulled back to the 50-day moving average. We did lose some price support in the process, though. When you break out, the TA 101, in my opinion, is broken. Resistance becomes support. And you can see here was resistance. We went through on some pretty nice volume. So when you pull back, you look for initial support there. We really didn't get it. Kept going, didn't even hold the rising 20-day, and we have continued moving lower. Now we are at the 50-day. You can see that the PPO is about to reset at the center line. I would watch this low back in March. I think if you break below there, I would be much more concerned about the stock. As long as this holds, then I'd be looking for maybe a return back up. So I'm going to play on this one a range from, say, 104 to about 112. I would trade that range.
All righty. And the most popular request is TECK, T-E-C-K. Tech resources, materials, non-ferrous metals.
Yeah, it's continuing to move down. You had a double bottom and then a double top and then a breakdown from that. So anytime you get a double top like this, makes me a little nervous. This low right here becomes pretty important support, because if you're trending higher, you establish this low, you want to see sideways consolidation. In this case, we've gone back below it, and the last time we went below it, we did so on some pretty heavy volume. It looks to me like distribution taking place here. So I would have some issues, I think, with this stock as it comes back up. If you're giving it, kind of like it's the final line in the sand, I think for me it would be the lows. We've got a double bottom now in place here. If that's lost and if we fail to hold or we fail to get through the 20-day, turn back down, and we lose this support level, especially on increasing volume again, I think that would be a bearish sign. So I'd like to see this 24.5 area hold.
All right. See, the next one, also a somewhat popular request, was blue.
All right, so that's Bluebird. That's in the biotech space. And we've talked about biotechs really struggling. We're trying to, I think for our Monday setups this week, you went with IMGN, and I had NKTR, Nectar Therapeutics. And we're, talking about how those were near support. And especially with yours, Aaron, it was starting to turn back up and show some positive momentum. Blue is trying to do the same thing. You can see the PPO has definitely turned up on this move, but we keep failing at 180. I would really like to see a breakout above 180 and get some volume in it, and then also start to see some relative strength in the group, because really it's hard to outperform the S&P 500 if you're part of a group that's not outperforming the S&P 500. And that's been the problem with the biotechs really throughout 2018 and even going back into the latter part of 2017. So I want to see this breakout, and I'd like to see some strength coming into the bios. Until that happens, we're probably mired in this trading range down here. I'm going to say 155 downside, 180 topside.
All right. The next one is, let's see, SLV. We'll do that next, and that is, of course, the iShares Silver Trust ETF.
Yeah, well, I'm not a big fan of silver, not quite as bearish on silver as I am gold, but as I pointed out earlier in the show, I'm pretty bullish on the dollar. And the dollar, a rising dollar is going to keep some pressure, some headwinds for silver. And so that recent breakout that we saw on the dollar literally has come in right at about the high on silver. I mean, it's the dollar started moving higher over the last 10 days or so. You can see what's happening with silver. We did put in a long tail. We're trying to hang on to some support around 1520. So let's watch that level pretty closely. If we get a close below that, I'd be careful because, again, the dollar is on a roll right now. I think we're starting a pretty significant move to the upside in the dollar. And so silver would not be on my list of priorities from a long perspective.
All righty. The next one I have for you is uranium, URA.
All right, Uranium ETF, pretty nice chart here over the past 5 weeks or so. We were in this downtrend. We did have a positive divergence, though. So let's take a look at that. Here you can see the lows that were in play. So you have lower prices. And when we bottomed there, you can see we had a slightly higher PPO. So you have a positive divergence in play where the 20 period moving average was really acting as major resistance. But once we got this established, this positive divergence, and started moving back up, we went right through that 20 and pulled back. And I'm going to say $13 now is a pretty key area of support. So I'm going to watch 13. You can see we moved up to 13, pulled back and went through it. We haven't closed below 13 cents. And now we're trying to get through 14. So currently we're in a trading range, 13 to 14, but I think there's an upward bias now as opposed to the downward bias that we had before. I would not buy it right here at 14. I think you're up against major resistance, but a breakout would be bullish. And if I was looking to enter on weakness, it would be back down close to that 13 level.
Okay. The next one is, let's see, EA. And that, of course, is in that toys space. And the person said with Electronic Arts, and I guess just in the toys industry, I think you've talked about 100% seasonality going into May.
I don't remember 100%, but we can pull up the toys and see. I don't think anything was 100%, at least not going back the last 20 years. Now, maybe the last 5. Yeah, there's the last 5 years in May. It's been, averaging going up 7.7%. But I look at a longer period. I think any sample is better with a larger sample size. So here you got over the last 19 years, clearly toys have gone up about 80% of the time in May. So start of the month to the end of the month, up 80% of the time. Average is going up 3.3%. If you take the gains and losses from the last 19 years, add them up, and then divide by 19, you'll get that 3.3%. So it definitely is a seasonally strong period. Now, that in itself would not have me investing in a stock. I want to see the technical merits of a stock as well. So with EA, I think the fact that we are at a recent low or we just hit a key support level, you could make an argument at that support area. And this goes back really since after that huge gap up that we saw back in late January. We pulled back, we printed a major low at about 116.5. We've been back there on multiple occasions. We haven't lost it. So I would be a buyer at 116.5, 117 with a tight stop, and looking ultimately if this sideways consolidation continues, then ultimately you could get to 130. Shorter term, maybe looking at about 125. Those are some of the key areas to keep an eye on. But a close below about 116 would really bother me with Electronic Arts.
Okay, and let's see, in the home improvement retailers, RH, and the company's name is RH.
All right, I think this might have been Restoration Hardware. I thought that was RH, but anyway, let's just take a look at the chart here. Big gap up. We came back down, held the rising 20-day moving average, and we've broken out again. So I would be looking for a continuation of this move up to the highs that we had established back in, looks like at the end of December of 2017, and then again in January of 2018. We got up to about 105.50. Now that we've broken out above 95, I don't really see any major resistance until we get up there. So that's what I'd be looking for. PPO looks strong. And again, if I was annotating this, one of the things that I really like is that on these pullbacks, we are holding, basically we're holding the 20-day moving average on these moves to the downside. So as long as that continues, I'd hold, looking for a target of about 105.50.
Okay. See, next one, also very popular, and one we haven't gone over in quite a while, Micron, MU.
Yeah, semis bounced a little bit yesterday, but this has been a weak group. And Micron, you can see the volume has not been light on the selling, and it continues to fail. It had one day where it kind of pierced through that 20-day moving average, but otherwise, you can see that 20-day has been really a problem for Micron. If Micron's to resume its uptrend, at some point it's got to get back through the 20. And I think I would wait until it does that. I think for now, it continues to trend lower. It came out with some pretty nice earnings, I believe, back in March when we had this gap up on heavy volume. And you can see that black candle printed. 62 now is a major resistance longer term on Micron. In short term, I think as long as this downtrend continues, I would be careful until one of two things happens. Either we hit what I think is very critical price support down below $40, 39 and change, or until we can get through this 20-day moving average. So for me right now, I would avoid Micron.
Okay. The next one is Tesla, TSLA.
They report after the bell today.
Yep.
So keep that in mind. I don't hold into earnings. Just look at a couple of the stocks getting hammered today after not so good reports. Tesla could be anywhere tomorrow. So for me, the risk alone would keep me on the sidelines just because of the earnings and the huge movements that we see on Tesla. As far as a technical perspective, you can see that the 310 area has been tough. Very good support when we were above it. And then once we lost it and the volume picked up, we've had tails go up to that 310 level, but we haven't been able to get through. You also have the 50-day moving average sitting there just below 310 at 308. So I think it's pretty clear to me. I want to see some volume come in, get back through 310, and then and get through earnings, and then we'll see what we have after that.
All right. And then let's finish with Universal Display, OLED. And a question actually came in with it. Do you think that it's still going to be kind of tied to Apple? And should we expect it to correlate?
Well, it certainly hasn't been correlating with Apple recently, last few months. And I'm trying to think back. I thought there was a story one of these big volume days. There was something going on with Universal Display and Apple, and I don't recall off the top of my head now what that story was. But I don't know if Apple was using a Universal Display and then decided they weren't going to be using them, or there was something, maybe ordering less. I don't recall. But this stock has been in a downward spiral. If there's one positive, and for me, it's maybe a little bit of a short-term positive, you do have a positive divergence in play. So you technically should be connecting these closing prices. So right there. And then finally, on the most recent one, you can see that we do have a higher PPO. Now, what this means is that the falling 20-day moving average that's been so key in holding back price action, we may get through that, and maybe we can get up that 50-day, get the PPO back close to centerline resistance. That doesn't mean that it's a long-term bottom, but it could be a short-term bottom where we actually can get through that 20-day moving average. As we moved lower, you can see that the volume seems to be drying up relative to some of these big hits that we had earlier on heavy volume. So short-term, I give it a little bit of a chance here, but I don't like the overall action. If we get back to the 50-day, and I would even say maybe these reaction highs around 102, of course, that would be a 10% move from here. But if we were to get up to that level, that probably would do it for me.
All right. And that concludes the 10 and 10. And you will find all of those symbols today in the Market Watchers Live recap. And I will have that up in the Market Watchers Live chart list for you. Also, just a reminder, I'll put Tom McClelland's charts in today's blog. And you can find links to our shows on the Stock Charts YouTube channel at the bottom of every blog entry. And with that, let's go ahead and talk about August. There we go.
Big event.
Yep. Are you excited, Tom?
I am extremely excited. I'm excited because I enjoy these presentations, but also it's great to get together with everyone that shares common interests. We're all really into the stock market, and it's technical analysis based. Even though my background is on the fundamental side, I fully am behind the technical theory. I think that the problem with fundamentals is they show up too late.
Right.
They're already, take a look like Snap. Snap, the stock's been going down for the last 3 months. It seems like it's not getting any kind of movement to the upside. Then we find out 3 months later what the problem is. They fell short on estimates and so forth. So technical analysis leads you a lot of times well ahead of those fundamental results. And so, yeah, ChartCon, you got some of the best technicians out there explaining how they manage their risk. Why wouldn't you want to be part of it?
Absolutely. And Tom McClellan is also going to be one of the presenters there. So I agree with you, Tom. It's great to go to these events and have all these people to talk shop with. It's just a kid in a candy store for me.
I didn't even think about this until just now, but ChartCon is August, and that's when Tom is saying that, we're supposed to be bottoming. So this could be if the market is really getting hit over the summer, this could be like the best presentation of all, because at that point, I would think Tom would be looking for a major reversal, but we'll have to see. But the timing there is pretty interesting since he's looking for an August bottom, and of course, ChartCon is that second week of August.
Yes, absolutely. That should be a great time. So if you haven't already, it's going to be an online conference, so very easy to attend. Currently, our early bird pricing is in effect, but it will go away on May 5th, which is, gosh, Tom, only 3 days from now. So if you haven't signed up, go ahead, save that 20%, and we'll see you there.
Absolutely.
All right, let's take a look at what's been going on in the stock market with a market update. And as you can see, it looks like, the Dow's coming back a bit, as is the S&P. We're still not in positive territory for either of those. We do see the NASDAQ has pushed back up into positive territory. And we've got the Russell 2000 small caps. As you were saying recently, Tom, small caps with a rising dollar tend to do well. And look at that. Russell 2000 not having nearly the trouble that we're seeing on those large cap indexes, as well as the Canadian TSX. The Toronto Exchange is up as well. Looks nice, just like the Russell 2000. Treasury yields are down somewhat, reading at 2.97%. UUP is on its way up, continuing its breakout to, it's right now reading at 24.34 for UUP. Commodities mostly unchanged, as with oil. Very volatile trading, though, today. I guess it's probably a comfort now that it is sitting right at its close from yesterday with all of that volatility. Gold is unchanged, mostly unchanged. VIX is continuing lower. We're seeing, even despite some of these declines that we're in the midst of, the VIX is still showing some bullish behavior, some bullish sentiment. And energy, as you were saying, one of the best sectors today. And you can see it looks like it's hit its intraday high. It's not able to push above that area of overhead resistance. And with that, I'm going to end the market update so that we can get into our scooter reports.
Sounds good.
Yes, I'll go ahead and switch over for that.
Yeah, take it away.
Yes, so what I do is I have of course, you have the opportunity in the tile here on the member homepage to select various items. You can get my DP signal board for the 4 major scoreboard indexes to see where we stand. And of course, the top 10, which is what it defaults to. But we also have the stock charts technical rankings. And you have the opportunity here right on the homepage to see who the top large cap, or in this case, we could go to small cap, which are the top 10. We can look at which ones are the big movers right now. I'm going to stick to the large caps because I know, Tom, you're going to look at some of the small caps. So we'll just go this direction. And also, again, the top down, who are the big losers today? And I know CHRW was one that people were asking about for the 10 and 10. So I'm going to just take a quick look at this. Again, it's great to have the opportunity in the space to go ahead and quickly see who's moving and who isn't. And obviously, huge breakdown today. We're actually trading the open, and right now the current price is below the 200-day EMA. So, we already saw that there was some trouble coming along when that 5 crossed below the 20-day EMA. Now today, as you can see, let's see, the 20 is right now by 1/100th of a point higher than the 50-day EMA, but more than likely we're going to see that intermediate term neutral signal kick in for the trend model, the DP trend models. But as you can see, scooter falling off the planet here. You do have some support possible here at about that $80 line. So we'll have to see. Let's go back though to that home page so we can see. I want to look more, I'm more interested at this point to see which ones are moving to the upside. And again, these are your top 10. You can just hover over the symbol and you can get a quick peek. What I like to do though is put them in my candle glance. And this is my decision point candle glance. You can set up your candle glance as any style you want. And all you have to do is set up the chart the way you'd like to see it in your candle glance. You know, if you want a 2-day, like I do with my Market Watchers report, or in this case, a 6-month, set it all up the way you like it, and then save that chart style as candle glance. And so if you save the chart style as candle glance, you're going to be able to see however format you would like instead of the default, which is this, which is hard for me to read, and it doesn't show the PMO, which is what I'm very interested in. All right, so we're looking at the scooter reports, at the scooter top 10 movers. And so I wanted to take a peek and see which ones are lining up the way I would like them to line up on a breakout with the PMO. Are there any interesting opportunities here or anything interesting that I see? I'm looking right now and I see, while this PMO has been rather flat, you can see, let's go take a quicker peek at this, because we just got a PMO buy signal. And I find that interesting. You know, of course, we got it on the gap up, but we were already starting to head up just a bit. There's that scooter, which is, you know, making that move, which is why it came on our radar right now. So what I would be looking at is, okay, we got the gap up, but we're already looking at some pretty serious overhead resistance. I'll just put that up here right now. There we go. So we're right now just butting up against that overhead resistance. This PMO buy signal suggests that we could see more upside and a breakout. I'm also seeing a positive divergence. We have rising bottoms here on these two. Barely, but it is. And then what happened to the bottoms on price? They are in decline. So this is actually a positive divergence. I think I would be feeling better about it if we could see the PMO get above this previous top. But I would say that with the PMO lining up, you can see volume is starting to pick up here to the upside. I would look for that break above overhead resistance, but certainly something you could add to your watch list. And again, this is coming straight off of, get back there as we go. All right, well, let's go this way. I'm just going to the scooters as a large cap, and I'm looking at top up, and I'm just kicking in my candle glance, and that's how I'm finding the possible targets, something that's interesting. All right, what other ones look interesting to me as far as chart pattern? Well, that's a great breakout here on Aptiv. Look at that breakout above that rising, that declining tops trend line. You've got the EMAs going in the right direction. Of course, with a 6.5% move, you would expect to see the scooter doing well. But I like that, like a bull kiss here on the PMO. It was a fake out. We thought we would get the sell. We didn't. We're turning back up. Bounced off the 200-day EMA. You know, I'd probably, again, keep it on a watch list and look for a pullback, you know, get it back into, you know, the range where it started out here. And that way you won't have to take in all of that gain and then hope for the best on the way up. But I would keep this on the watch list, and actually intraday, if it were to back off a bit, I would consider that as well. So I'm going to pass it back to you, Tom. We looked at just a few, and again, it came right off of the member homepage, the technical rankings right here. I picked the top up, the best movers, did a candle glance, and there you are.
All right, let's take a look. A little different approach. We saw obviously that the small caps have been outperforming. You can see that on today's chart. The Dow's up 5. NASDAQ, you can see if we pull up that chart here, is up 9. So it has moved back into positive territory. S&P still down a couple points, but moving in the right direction. And then you got the Russell, which is currently up almost 10 points, 3/5 of 1%. And been performing really well off the lows from yesterday, continuing to move up. And that's what we should expect with the rising dollar. We should see the small companies outperforming because they're not impacted negatively by that rising dollar. So keeping that as a theme, I go in and I look at scooters. And now there might be a particular area of the market I'm interested in. But here is the large cap, mid cap. I'm going to choose small cap. And I'm going to look at the change today. So I might, focus on small caps, look at some of these scooter ranks, up in the upper 90s. That's telling me those are pretty good stocks. But by using the change, first of all, take a look at this is a little bit of a lesson. ESPR, this is in the biotech space. Stock's down 32% today. If you own an individual stock, especially a smaller one in the biotech space, you got to be really careful. This is, maybe an extreme, but it does happen. I see this happen often to small biotechs and pharmas that depend on maybe one product, or there's one thing that's going on that they really need to come. It's like putting all your eggs in one basket, and then all of a sudden the basket drops, and ESPR really getting hit hard. But let me go back and take a look, because I'm going to look at the ones that are moving. Now, in this case, what I'm interested in, these are the ones that are jumping the most in terms of their scooter rank. Probably have an incredibly good day, many of them. But I thought what I would do is maybe look at the ones where the scooter is moving up a lot today, but it's just getting up into the upper 60s, 70s, maybe low 80s, and just pull up a few of these. So let's take a look at AQMS. All right, here's a stock that gapped up beautifully back in February, went sideways. Look at this breakout right here above $3. Now, it got all the way up to 360 that day, and I always talk about you don't want to chase. Let it come back. A lot of times when a stock breaks above resistance, broken resistance becomes support. Next day, AQMS comes back down, hits that $3 level, and now 2 days later, we're back at 370. Now, these small caps move, or can move, a lot faster than some of the big companies. So you have to understand going in that there's more risk. There's obviously more return possible, but you're taking on more risk for sure. But just using the small caps as an idea or as a theme to start, using the scooter report, which is exclusive to Stock Charts members, or actually, I don't know if you can use them as a non-member or not, but I know as members you get it, and you're not going to find it at any other site. And so quickly you can, work and find something that could be working in the current market, even though the market's been pulling back. Because again, we're seeing outperformance by small caps. So that's why I want to focus here. Taking a look at a couple others, let's look at Chicago Bridge and Iron, CBI. Stock had been moving lower. It looks like maybe an exhaustion gap to me. I think we may have mentioned this one on the 10 and 10 the last day or two. I wanted to see this thing get back through about 15.5. It did that yesterday on increasing volume, and look at it go now. So here's a stock that definitely appears to be picking up momentum in that small cap area. Let's see. Next one, let's do with MyTech. MyTech's got a scooter rank of 72.3, but it's basically doubled today. And MyTech, look at the breakout. Now, again, this doesn't mean I would just go jumping into a stock that's up 11%, but I would recognize that things appear to be changing here. Look at the volume coming in. This would go on a watch list for me. Depending on how we close, maybe a pullback to test this 810 level tomorrow or maybe next week might be interesting as the rising 20-day moving average starts to move higher here. So there are a number of different ways to play stocks like this. You can go down the list, though, and there's a lot of different sectors and a lot of different industry groups that are represented here, which I think is really important as well. Here's healthcare. So we looked at MyTech. This was technology. Chicago Bridge and Iron, that's an industrial. Aqua Metals was another industrial, but a different industry group. And now let's take a look at Genmark, which is in the healthcare space. Here's a stock broke out above this double top. Now, this one didn't come all the way back down, but notice yesterday we were pretty darn close to the 20-day moving average as we were getting close to those reaction lows. And now today, all of a sudden, stock up almost 10%. There are places that you can look to trade in the market, and I don't own this one, I wish I did, but there are always places to look in the market for opportunities, even if the market overall is consolidating the way we have been for the last few months. So really that was what I wanted to go over, is just show you how you can start with a theme in the market, move in, use those scooter reports that are exclusive here to stock charts, and be able to zero in on what appears to me some stocks that are starting to show some relative strength, even though the overall market is struggling.
Yeah, but it's pretty interesting because I know Greg Schnell, I think he talks about it in his book, Stock Charts for Dummies, that you can find in the stock chart store. I know that he talks about trying to use the scooter as far as finding basing patterns in a move up. And one of the things he suggests using that report, very similarly to the way you're talking about it right now, is looking for those that were in that bottom 25%, so they had a 0 to 25 scooter, but then they had a move, a big move that got them out of that last quarter quartile. And apparently it's pretty good for finding breakouts off of some basing patterns. So something to think about.
And there's a summary slide that will show you some of the things that Aaron and I just talked about, different ways to use the scooters. And again, I think it's a great tool, and it's one that just makes sense. I mean, it's looking at using, well, you can go in the chart school and go through the calculation, but there is a weighting to long-term indicators, a heavier weighting toward long-term actually. So for those of you maybe that are looking more from a longer-term perspective, I think the scooter makes a lot of sense for you. But it also has weightings for the medium term and then also for short term. So
yeah, we did ask everybody as a poll, how often do you use scooters to find stocks? And at this point, half of you are say sometimes. I was in the always camp of 25%, and then never was 19, and then 5 didn't know what a scooter was. So hopefully we helped clear that up for them.
yeah, and the scooter stock chart's technical rank. So that's what the acronym stands for, and it was developed by John Murphy. So right there, there's a lot of credibility in it, and he uses technical analysis to basically, it's almost like a scorecard, or like your report card that you used to get from school. Kind of telling you about each stock and how it's doing relative to its peers. And so I think it's pretty key part of what we do here at Stock Charts. And if you're not familiar with it or haven't used it, you probably would find that there are some uses for it in your trading or in your investing strategy.
All right. What a great show today. I don't know if Tom McClellan changed her mind about an upcoming bear market, or, well, an upcoming bear market, basically. He's helping me sway me a little bit more to raising the bear. I'm in the bear market for sure camp. I'm still neutral, but I would, after his presentation, I'm considering moving into that bear market camp.
Yeah, I have a lot of respect for a lot of technicians, including your dad, and for Tom McClellan and what he has to say. For me, it's mostly about price and volume. So if we lose that double bottom on the S&P 500, then yes, I would absolutely say that we got a good chance of having another big rush to the downside, and that's something to watch out for. Let's go through the weekly schedule real quick.
Big week. We've got Bruce Frazier, Mr. Wyckoff tomorrow. Chip Anderson will be here for Everything Stock Charts on Friday, so you won't want to miss it.
Sounds good. Still got a bunch to go rest of this week. I do want to thank everybody for stopping by. I appreciate Tom McClellan joining us for sure. Please remember to complete the survey. I'd love to hear what you thought of that presentation today, and also what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.